thanks again for coming today. And I won't bore you again with the same stuff I already talked about. But I just started mentioning that my background is maybe not the most traditional one, because I've been an assistant professor in the University of Copenhagen and have the nice luxury of working almost solely on blockchain technology, which is super awesome. And yeah, also funding and being CEO of Firmo, which I'll tell you a bit more about it. And yeah, but let's discuss first the topic of today, a little bit more about the future of funding, and specifically the topic of ICO. I would appreciate a very interactive presentation, so just bump in whenever you have something to say. Not too formal, it's still Friday bars with a couple of beers, so let's get it going. So a little bit about my background in more details. So I worked for many years with certifying code. I started doing this for actually in the Air Force, dealing with airplanes, where sort of, let's face it, that if you are now in the air and there is a bug and the airplane will start falling down, you may not appreciate it very much. Apart from it, I worked a lot with software development in a variety of places, including Microsoft, including some of the banking sectors, and being a serial entrepreneur. I opened a variety of companies, a lot of them within the financial sector, and dealing a little bit with automatic and algorithmic trading, which was a lot of fun. And yeah, and after working a lot on the academic side on blockchain technology, I wanted to gain some more impact on what's going on in the industry. And as part of doing it, I was involved with a couple of projects. One of them is Banker, that I think did one of the top 5 largest ICOs, writing the white paper and being interrupted and working closely with the team, also on other stuff and being advisor there. And Kulos, you may know them, that they're working a little bit on community currencies, mainly in the cities of London, East London actually, and Liverpool, if anybody here from Liverpool, and also in Tel Aviv and Haifa. They work with community currencies and they base their technology on blockchain in order to create support into different communities and actually look a little bit over that. If anybody is interested, come and chat with me about it. I think they are kind of very interesting projects. And also about Firmo, but we'll talk more about it a bit later. So again, probably many of you and most of the hype around blockchain comes from the huge increase that we've seen in market cap. Maybe the last days is a bit lower than it is today, but still we've seen a lot of interest coming as a result of it. But we, and I guess many of the other people here, see much more than the market cap in blockchain technology. And when we start discussing a little bit more about ICO specifically, I wanted to mention some of the numbers that we've seen changing along the very recent time, right? Because this graph only started in Q1 16, right? So we're talking 1 year ago. And I think the funding numbers for the last 2 months are roughly this Q3 numbers each of the last couple of months. So the numbers are going quite massively, but we see a huge change between a world where equity funding was the most common way to fund the project, especially around blockchain technology, to vast majority of jump in an exponential manner. And we see today a lot of these projects actually funded by the crowd. Not so much, I think this started a little bit in the Nordic. I think WePower from Sweden has done a little bit about it, but not so much yet in Denmark, but it may or start growing here. And we're very excited to try and help some of this process. We think that this is a very sort of an interesting model, and we want to talk a little bit about the benefit and challenges in following this model. So one thing to mention when we see the growing of numbers, to say that the fact that these numbers has been growing exponentially doesn't mean that each individual company raising today will actually see that level of funding for just poising down an ICO. And we can see there also exponential growth in the amount of companies that are actually issuing ICOs. And if you actually look into the number and specifically look into the concentration of some of the big projects within this number, I think that I've seen some statistics that about that roughly 40% of the funding raised was raised in the top projects. So we see both cases in the same time. And yeah, so just to mention it with a bit of salt, that the fact that we do see a lot of funding, it doesn't mean that that we won't see quality projects that are more likely to be funded than less quality projects. Yeah, as I mentioned before, people just interrupt or say whatever you want during the presentation. I wanted to mention some ways to deal with the issues of ICOs, because one of the main challenges with the ICO funding model is the fact that as shareholders, at least not in a traditional manner, you have less impact of what happened within the company. And while this is a very exciting opportunity, allowing a lot of people within the crowd to be able to participate in a variety of projects. What I mean by participation is that you do not have to be a full-fund VC in order to participate in starting a new project, or if you see a project you highly believe in it, you can actually take part of it. But on the other side, the way in which companies today control this project is much more limited. And this gentleman here, Vitalik Buterin, suggested a new model where part of the funding, while it will be received, while the ICO funding will be received during the ICO, we'll try to support some more milestone achieved by the different companies as part of the process of funding it. What does it mean? It means we'll try and put two projects or two ideas together. One idea is to try to use this decentralized world to allow governments of some projects, and then allow the shareholders or the holders of the token to actually decide, do you still want to participate in it, and potentially have the possibility to either stop funding for projects if they think that the development is not as expected, or try to have other ways to impact it. So that's in some way a very interesting model to try and still keep some of the control with this project by, let's call it, the rest of the members that actually fund it, but it's still a big challenge. And it's still a big challenge because we've seen in a couple of projects that do try to use this combined decentralized autonomous organization, that it doesn't work as slightly or as simply as we've seen. I guess one of the examples, I guess, is Thesis that a lot of people talk about recently. Let me pause for a second to have a sip of my beer. And also I would love to hear actually your thoughts about it. What do you guys think? Cheers guys again. What do you guys think about the model?
I have a little concern about the ICOs, because what's to keep the issuers of the ICOs to just keep the money for themselves rather than just going along with the project? I mean, what's your certainty as a consumer or an investor to actually believe in the project? Right.
So the question was, how do we ensure that the issuer of the coin or utility would actually continue funding it and not would just abuse the funding? Would you say that would be a short summary? That's a good question. I think, but it has several parameters, and I would not also want to be the only one to responding for that. But I think that one of the cases is, of course, what do you mean by using the funding, right? They may use it non-properly, but I think the funding will not be taken personally by any of the persons, right?
Well, that was my concern. That
really?
Happen.
Right.
Because what's to keep them from? Is there any legislation to keep them from doing that, or is it just you have to trust them 100% as an investor?
Right. So the question is about legislation. I think that most of these projects, so it's a good question, most of these projects are formed either by a foundation structure, which is regulated. In most foundation, I guess, regulated often by the Swiss regulation for that. And other models could be regulated in Gibraltar or other countries that actually look into offering a DLT license for these companies. So it's not more like receiving the funding personally, but it's received through some cooperation. So there is still some cooperation structure. Of course, you can say that like any corporation, depends on the country where this corporation is built in, there could be a lot of effects on how much control you have over it. Usually the companies actually specify that, where they're incorporated and how regulated they are. And as a side comment, I've seen that some of the companies, and we start seeing more and more of it, also in the case I think of now the block shipping ICO that happens here, that I think they try to issue a little bit more transparency via means of actually reporting more than they necessarily are needed. But it's both the corporation structure and a little bit about the possibility of the company themselves to do more. You can again question that. Would you like the companies to regulate themselves? I've been last week in FinTech Tel Aviv, and we had a very interesting discussion about it, also with Jed McCallum and a few other people, discussing a little bit about the subject of would you trust companies to self-regulate? And that's again a very big question. And I'm not sure there's one answer
goes
for it.
against the whole idea of the blockchain because it's decentralized. So
Yeah, you decentralize the process, but centralize the decision on the other hand, right?
Yeah.
That's very interesting.
Yeah.
And I think we will see more and more self-regulation, and I hope that we will see more and more sort of governmental involvement with the regulation. I know that we are looking forward for that, because it's complicated, but it's also, let's say, for something so innovative, it's sometimes hard to work from the first day from the government, because they don't know how to eat this frog, they don't know where exactly is it located, right?
Have you seen any examples where let's see, the coins are correlated to equity, so they could be converted later on?
So the question was if you've seen examples of coins which correlated to equities.
Yeah. So it could be like convertible loans, not part of a type of convertible loan.
Right, like convertible loan. So it's complicated. What I have seen are cases where a company is going through the ICO process, issue not only one coin, but sometimes a couple of coins. One example we've seen recently is a company that issued a sort of a stable coin and issues the genesis of the stable coin to actually represent the basic of what was invested in, and that will be sort of a security kind of token, and later on allow the holders of that to convert it to a utility once more and more development has happened. So you can have some changes in that side. But it's a bit complicated. A few other aspects that may affect the element of ICOs and thinking ICOs, the funding possibility, is also what does it mean from a company point of view of having ICOs? And one of this sort of interesting article from TechCrunch actually mentioned the possibility of looking at ICO in a different way than it looks today. Not necessarily as the first stage where a company will start raising funding, but maybe as a next stage after the funding are achieved and are obtained by the company, allowing the company directly to somewhat reduce the value of equity. So what does it mean? We see a lot of the strengths now of big corporations. It could be like Google or it could be Facebook of the world. And we see more and more discussion, especially if we're talking about some of these Facebook and LinkedIn companies, that they actually may be utilizing our private data, and that's become this data is then again owned by the company, and to some extent they make profit based on using our own data. And as we see in today's working models where data become much more often actually the share of value within the economy, we may see the case where people are not so happy with their data being used to profit someone else. So we may be able to see a case where big companies that raise a lot of funding, we also may see something similar today in the case of Telegram, that they will issue that they no longer want to be a private company, but somewhat create a larger base of shareholders, each of which will hold a small portion of that, and in that way somewhat allows you to get back some control over your data and over your equity. So I think that's a very interesting model. It's somewhat to say we do not longer want to be a company necessarily traded on the NASDAQ or the New York Stock Exchange, but we want to sort of, as this picture may allow, distract the company and make it again sort of a coin that may be transferable and allow each of us to sort of receive returns based on the use of the data. And I think that we've seen also more and more ICOs looking into data and content management, trying to look into the area of what do we do with data, what do we do with content, can we license content via that, both for some cases like the music industry, which is a great example, and also cases where we look into photography and who has the license for photos and other cases. Last point maybe to mention in regard for some ICOs is the point of mention that what does it mean from a company point of view to issue an ICO? Because in a sense, some people look at ICO and say, this is awesome, right? Because now we can say we're a blockchain company, and that's a great thing for maybe our stock. And at the same time, we receive a lot of funding coming towards us to operate us, to cover operation costs, but there is no price to pay in terms of equity. So, everything is fantastic. We're just getting some funding, zero commitment. But I think that we'll see more and more cases that the issue of the ICO will also issue a lot of the IP of the company. So we'll see the company have to compromise a lot of the IP and in some sense reduce the value of the equity in the company. And I think this is something we start seeing more and more discussion and understanding of, but I think we're very much early in this stage because it's a new idea, it's a new technology. So what does it actually mean? And actually I would like to ask the question back at you guys. How do you see the movement between equity and potentially coin from a point of view of a company that is issuing an ICO? And how do you sort of convert one to the others or dilute them? I think I see some people here from the VC world. I think they may... And in that regard, I think that this is a very challenging case to look at because we have to be very clear about what is actually the other side, right? Because we won't see the case that you can just again and again sort of issue more coins and just create value for the company without necessarily giving up any IP related to that. So yeah, but this is very, very quickly. Yeah, please.
Concerning equity to coins to issue, yeah. But do you have examples where people have correlated from the beginning, saying the value of this coin is so much compared to the traditional value of a company?
I'm not sure. So I'm not sure about an example where you compare the value of equity to the value of the coins.
Because what will happen if companies do an ICO later on?
Right. No, but I think this is the case of really trying to get a separation between the value of the IP. And I've seen, the closest thing that I've seen that could also be an interesting model to look into sort of regulating the value of the IP in a company was to look into the case where you try to prevent the domination of companies on the other side. So one example of those could be looking into a creation, for example, of a platform that will limit the bargaining power of a company. What do I mean by that? We see again and again the cases of, let's call it the Ubers of this world coming into and trying to disrupt an industry, and later on being potentially one of the big benefiters from the industry, right? Because they have a strong network effect within the industry where they control a long part of the supply chain and control a long part from what actually is running out there, and then can use this bargaining power against potentially drivers. If we take the case of Uber, or if we take back the case of Google, they again control the data and they may be able to utilize it for whatever they want to. So what we can see as a model is a model where the chain itself will agree about what is the value of that negotiation, and will, for example, do not allow dApps or decentralized applications, such as decentralized, call it Uber, to be able to take part in the negotiation of the drivers. So they may only be allowed to issue dApps on such platform that can take up to 5%, say, fees. And this negotiation and bargaining power is not possible within the application because you can prevent it on the protocol layers. So if you put this kind of application on top of it, you may be able to prevent the case of a company later on by being part of the supply chain, able to change the prices. But let's move a little bit forward. And I went the other way around. And I wanted to discuss a little bit a more concrete case study, which has come from on, about looking into the value of actually formally verifying financial instrument using blockchain technology. And I think before we dig in much detail for this case, I want to mention what do we mean by that. So to start with it, we mentioned that the today's economy is very much credit-based, right? I mean, how many people here have $500 in their back wallets? Anybody in this room has $500? I mean, I usually, you have $500 in the back. But good for you. But I think in Denmark especially, we hardly see cash, right? And especially in Scandinavia. And the reason is that credit in most developed countries have actually taken the vast majority of cash. And that means the trust works a little bit different when you look into credit in comparison to looking into trust the way it's done in cash. Because if you deal with cash-based economy, right, you can be robbed any minute, and we hear a lot about these cases, and you can also not scale economy based on cash. So we've seen before how growing the market for blockchain has been at the moment, but we know that a lot of it is cash-based, because eventually you sign something today and you transfer some funding from one point to the other. What we try to look into in Firmo is actually trying to separate these two things far away from each other. What do we mean by that? It means that we can create the handshake on the agreement potentially earlier in time, like you do today when you pay in a credit card, but then initiate the agreement itself to happen and the transaction in the future. So what we mean by that we can try and increase the gap between the two things and allow scaling economies. So the reason why we see this challenge a lot is because, in today's economies, when we're looking into transaction and handshakes, we see the case that it's very, very difficult to scale economy based on cash. Taking it a bit forward, we mean that what we do with the transactions that we create will later on allow you to transact them on your blockchain of choice. Currently, we mainly support the Ethereum platform. And later on, you can deliver and use this protocol to create a vast variety of financial instruments. Some of them could be swaps, but some of them could be credit, as can be using credit cards and other platforms. So what do we mean by that? We mean that a potential transaction, such as Ether to Gnosis, that could be done directly, can be governed with a very short amount of code base that will define that transaction. And this transaction, if you can increase the security within this transaction, you can actually scale financial product as economy. So what we aim to do is to somehow simplify the true supply chain that we see today in many of the financial institutions, and creating a much smaller infrastructure based on some ledger and powered by Firmo that will somehow decrease the supply chain around a transaction. And I think anybody here that works around credit and issues like that have seen how complex is the model and how many different ledgers you have to reach into agreement in the supply chain. The reason why we don't see today the scalability between transactions and handshakes, as mentioned before, and the reason why we see often today cash-based transaction, is the issue of security in smart contracts. So I guess the most notable example of security issues in smart contracts are the DAO hacks that I'm sure many of you heard of, where roughly $150 million were unsecured. And that was, at that time, about 20% of all the Ether in circulation. So if you try to move forward for today, we talk about something like $20 billion. And that led eventually for the hard fork over Ethereum. And the reason was that the re-entry bug within the code of the DAO allow users to actually take out some of the funding around it. More recently, in this year, we've seen twice parity wallets, once hacked and once money frozen inside it, when again, users that have actually saved large amount of money, in this case roughly $280 million, had hard time in actually, and not possibility, in getting their fund back. And the fact that you would feel that getting involved in a smart contracts will prevent you from getting your fund back may not make you very excited about participating in smart contracts. What we believe, and many others, is that this is just the tip of the iceberg. And why is it the tip of the iceberg? That while these are two canonical examples, we've seen research looking at roughly 20,000 contracts, and there is actually extension of it today, and almost 45% of those had some different kind of vulnerabilities. And these are the ones that were found. So it seems that the question is much more, do we have a reason to try and attack these smart contracts, or do we actually contrast them? What we achieve with our technology is being able to reduce some of the risk by actually trying to use formally verified code and a lower amount of code to actually allowing users to actually scale the platform. More specifically, this technology has not been invented today for the source of blockchain technology, but is used in many real-time cases where a bug can be too hard for us to handle. I mentioned before working in the airplanes industry, where this has been the standard for a very long time, because we don't want to be in the air and suddenly having to restart our system and see the airplane not reacting very well to it. Other cases where we actually seen it are train scheduling, where problem in scheduling could lead to a loss of life, and satellites, where you try to commit today for some long-term agreement. So what do we achieve by actually using a language which is formally verified is the potential to have much more security in the code, being able to achieve built-in logic checks, such as, for example, not being able, if right now we interact in a transaction over a peer-to-peer loan, and one of you guys would lend me, say, 500 Ether and ask me to return tomorrow 500 Ether with some interest, you may be subject to the fact that miscoding, if I say my return is dependent on the interest rate a month later, that the code will be stuck and the funds will not come back. So what we achieve by that is actually the possibility to prevent such a contract from being compiled. So in the first stage, a developer will not create such bug to start with. And lastly, and quite importantly, is working with intuitive syntax and a much smaller code base, which is very much focused for financial services, allow for lower amount of bugs and a higher possibility to secure the code. Again, creating this language in an agnostic manner from the blockchain language itself allows you to later on be able to support a variety of blockchain technology, not being dependent of some CryptoKitties sitting over Ethereum or anything else that may prevent you from scaling your technology. So how does it work? We'll have a varieties of, in this case, you'll have a varieties of people initiating a transaction. This could be from exchanges to individuals that are licensed over the technology. Their contracts is signed, and that contract later on, by using our platform, would create a deployable code on any blockchain. And to start with, we support Ethereum. Later on, if this contract has to settle in the future, you can either automatically execute it via our API, or otherwise directly support it yourself and run the contracts again and make sure that the settlement of the payment actually happens. Later on, you can power by this technology a variety of use cases. One of the most exciting one, in our opinion, is actually the building of a decentralized exchange, and we have some examples that may work both for decentralized and centralized cases, where you can create some futures contracts, for example, and options, which are issues that are very, very vastly known and used in the more traditional world, but hardly used on the blockchain world because of the issues around trust and the issues around the difference between handshake at one point and payment happen in the future. We currently have quite a large team working on the project. Actually, a few of the team members are missing from these slides, but it's a fairly experienced team within the blockchain domain. We have a couple of experienced entrepreneurs, both within some of the team has been already been exiting a couple of projects and also been involved in an IPO before. Apart from it, we have very skilled CTOs that work a lot within financial services, also with peer-to-peer lending, which is one of the most interesting use cases for technology. And we have a few other people from this domain, also including Annalisa, formerly from Singularity University here, so to mention it here, and Elad, which used to work in Colo Technologies before that. We have a very strong academic advisory board with people who show a lot of interest within a lot of these problems. Some experts within issues of formal verification, technology and business around blockchain technology. Last, we have some academics and more industrially based collaboration from the industry, and we have also a few more interesting ones coming up. So stay tuned. I think next week we're going to release some more information on that. Yeah, so this is a bit about ourselves and a little bit about our Telegram group. Thanks for suffering with us through Friday, but I guess you have to work hard to get some free beer, so no free lunches. And that's enough for me for today. So if you have any questions, just go and shoot. Thank you very much. And just before answering your question, I'll mention we're recruiting at the moment. Yes, please.
You mentioned you use Chorus as a programming platform. How common is that?
So the question is about the platform, how common it is. So this is our platform, it's our language. So in that regard, it's not yet the most adaptable language, but it's very easily to use. And again, I don't want to bore everybody through everything today, but we actually have working prototype, and we can actually show how an exchange can actually utilize our technology as a baseline. And we think that this can be utilized in several manners. So one manner could be writing code directly with the API and the language, which is exciting by itself, and can allow exchanges and peer-to-peer providers to actually interact directly and create these contracts. But also we will form some templates that people can potentially utilize some of these templates directly to create these contracts. So they don't have to be all coders. So there will be the possibility of creating it via template or creating it directly via the code. If I had more time, I would actually show a coding example of it. So, but we can check it off.
What's your plan for getting traction?
Our plan to get traction? Can you elaborate a bit more?
As in, are you going into partnerships with different players?
Right.
Or are you trying to create it bottom-up with the enabling contracts that everyone can do? Or?
Right. So our plan in terms of getting traction is to partner on a variety of levels. So on one level is the blockchain level. So we're going to look into some, and we're currently in discussion with some of the biggest blockchain in the world platforms. I won't mention names because we haven't signed anything yet, on actually enabling our technology to support other platforms apart from Ethereum. A second element is to support decentralized exchanges. So we're actually discussing now a partnership with one. And the third case is to actually trying to see how we can support centralized exchanges. And we're also discussing that with a partnership.
How do you make money?
How do we make money?
Yeah.
This is an easy one, so thank you. So the platform makes money from the actually users of the execution of the contracts. So we are an infrastructure company. So whenever a contract, if we take the example before, is okay, if it moves or not. Yeah, whenever a contract is powered by Firmo, then there will be some fee distribution model around it. So if it's run on a centralized exchange, a fee distribution model, if it's in a decentralized exchange, you can actually, part of the transaction itself will utilize the coin, and the coin will be burned when such happens.
Which leads to my next question, which is, if that is transaction-based, and I manage to get a lot of transactions through Firmo, how are you keeping me from not doing the formal proof myself, and then do those executions because I now own the end user?
Can you repeat your question, please?
Yeah, so my question is, you do that transaction-based, but since you're the infrastructure company and you provide formal proofs that the code will execute as promised, if I manage through this platform to get a lot of users, how am I prevented from doing formal proof myself on the side?
Okay.
And then remove all of the users?
Right. So the question is, how do you prevent from a platform to do what we're doing? So I guess it's a specialization case. So from our discussion with exchanges so far, their main area of focus is providing and working around liquidity and increasing user base and increasing throughput. If they can easily integrate our technology and have us allowing them to issue much more products and can focus their work on other areas, it makes better sense. On the other hand, the fact that we are not necessarily a specific exchange also makes it more easy for us to enable moving some of the technology and transfer them across exchanges. So if assets could move between exchanges, which is something we will look into on developing in the future, this can be very interesting. And I'm sure that maybe Bittrex will not like to put Binance option on top of it. So by actually being an independent provider, you can actually provide that as well.
I'm curious, exciting project, first of all. I'm curious if I understand your project right, you allow for different like options, swaps, futures, those kind of things with cryptocurrencies. What's the response? I mean, if many crypto enthusiasts would say, I mean, the great fallacy of the normal economy was the over-financialization and gambling and Wall Street and such. What's the reception among? I mean, I imagine it's different when you talk to some crypto enthusiasts versus bankers. So can you talk a little about what's been sort of the reception in the community?
About the financial product, the reception of the financial product?
About your platform allowing for the financialization
right.
of cryptocurrencies.
So I think our our interaction with people has seen a lot of excitement in the technology and also in allowing it, because as mentioned earlier in this discussion, right, when we define Firmo, right, we do not define ourselves as a financial company. We're not a financial company, right? We're an infrastructure company, and the infrastructure we enable is the gap, again, the gap between a handshake today and a transaction later, right? So what we actually enable is the ability to move the time across, right? Not to need to do a cash-based transaction today. That has a variety of implications, not only creation of future contracts. If you want to create a peer-to-peer loans and you're going to loan money from different fellas, you also want to make sure that you handshake today, receive the fund today for the peer-to-peer loan, and you got a transaction later, right? The transfer of the interest or whatever was achieved will happen later. Another case could be prediction market. Looking into prediction market, where you try to predict what will happen in a soccer game, right? It doesn't have to be necessarily blockchain related or anything else. You transact today, right? You do the handshake today, but the transaction itself happen later. So this is where we are very focused on it. Another reason why we focus on keeping an infrastructure on very limited area is because we're big believers in specialization. We think that if what we do is that very specific thing of enabling, and everything else will be done by a lot of variety of smart, great people, you know, we'll have a better economy, better decentralized world around it. So we don't want to say, we'll come tomorrow with our own blockchain because it sounds sexy. No, we want to join existing platform and support them. If our throughput will become so big that we need to move our own blockchain, we'll do it. I mean, we could have forked Ethereum today, put our domain-specific language on top of it, and call it something sexy. But we're not interested in it. We're interested in actually being part of an ecosystem, supporting infrastructure, and enabling security, and making, again, this possibility of handshake today and transaction later.
Maybe it's a naive question, I don't know, maybe you mentioned it, but how, like, if you separate the handshake and the transaction, how do you ensure that at the time of the transaction, that person that needs to transfer the fund has the fund next time?
It's a good question. So yes, how do you ensure that there will be money on the other side?
Like the collateral when you enter the contract, for instance.
Fantastic. So there are a variety of answers to this question, how to ensure it. One answer is using collateral, and another answer is to try and look into different ways also to ensure such transactions. What we look into is using a lot of this collateral and labeling them via code, and potentially allowing people to interact that way. Having said that, just as a disclaimer, right, it's not to say that it would never be possible for a wrong transaction to be created on a platform. The idea here is to enable more secure element. Also, when you look into airplanes, right, they still fail from time to time. But on real-time system, you want to really ensure that reduction of failure rate. And this is what we actually provide.
Just a question. From my understanding, you're preparing for an ICO currently. What is the motivation for that compared to going for more traditional funding, source of funding? And also, if for those participating in your ICO and purchasing the token, how are you advertising it? What is the benefit of participating in your ICO?
Okay. So the first question, why do we go for an ICO? And the reason is that we think that the most strong element in this world today is network effect. I mean, I'm personally sick and tired from big financial institutions which is completely centralized. And good luck for them as long as they live. And if I could be part of trying to help decentralizing and creating a big network effect between this world, I'm super excited about it. So that's for the first question. And I think this is something I know how to achieve as part of this ecosystem, but I would not know how to achieve in traditional funding today. It may change tomorrow in the future. What was the second question again?
Those participating in your ICO and buying the token, how are you kind of in a way going to advertise it? When you are going to purchase your token, what are we getting out of it if I were to purchase your token?
Right. So
part of the company or?
So let's divide it to two, right? So first, we don't advertise necessarily anything for you to gain from being part of it. It is a protocol that's creating an infrastructure. So we first want to aim at people that are excited about it and think about that. The second thing is that obviously, as I mentioned a bit earlier, this token will be utilized, right, to provide some utilities on the platform. An example of the utility is transaction, right? So whenever transaction will happen under that platform, there will be some fee paid for the actually enabling this technology. So as a participant, you will be subject to some of that in a sense, because you'll have to, this utility, as this demand for the utility increase, and if the project get to bigger domination, there will be also be remuneration about it. But we don't try to advertise for that specifically. What people usually see when they look into our project, they look into the size of financial infrastructure services, and it's pretty huge. And a lot of people are really excited about the technology. And it's pretty clear that if you manage to get to dominate around this area, there will be value around it for the community. Two last questions, I guess, right? You can go first.
Okay. How do you think the blockchain financial infrastructure system is going to evolve? Is it going to be just as complicated as the one we have already? Because when I see your product, it's not easy to understand what you do, but it's a layer again on top of the blockchain, the financial industry. So I'm just worried that we're building something over here that was supposed to be simple, but it's going to be just as complex as we already have.
Right. So I guess so. The question was about the complexity. So I would almost shoot back at you and say, how do you define complexity? Because
the number of players in the industry and the number of things that are gonna make certain that a handshake also results in a payment. And if a lot of players are coming into that just enhances the complexity.
Potentially. I think that while there's of course a lot of complexity around it, right? Anything to do with blockchain has more complexity in how consensus work and how the infrastructure are working there. On the other hand, there is also a lot of transparency that is received there, and I think it has a lot of value. And at the same time, I think that one of the issues we see, if you allow me to go back for the initial slides around the financial services, and I'm sorry that I have some good friends from Nets talking to me a lot about it, is that in this case, when you go in and buy an airplane ticket, for example, you think that you transact with one person, but actually you transact with a multi-layer of element in the middle, right? It is a very nice user experience, and this user experience can be imitated on a blockchain as well. But having said that, you will have some credit cost for that, right? Because there may be some issues of credit. There are issues with the different providers. There is a loan that is taken in the middle, and you are not aware of it. And part of this lack of awareness means that the pricing along with the supply chain may not transparent. Because it may be that some players have some specific agreement with other players, and eventually this is turned back into you. Like one of the things I loved a lot in Denmark, and I still love it, is that when I go and pay with my MasterCard, I pay more. It says it's 150 krona, but when I pay with my MasterCard, it costs me more. And why I love it? Because it means that I don't pay this fee implicitly. Because if I pay with my MasterCard and it will cost me 150 kronas, it means that somewhere else in the supply chain, when I pay for my groceries, this payment was transferred back to me. So I think one of the benefits that's coming from transparency is the possibility that if any players here in the middle does not do their job, they will be kicked out. Taking it back to us as a financial infrastructure company, and if we're looking into infrastructure, if the infrastructure is not efficient enough, a different infrastructure will be adopted. And I think that keeps you motivated on doing one thing, rather than trying to control the full supply chain. And I think this is a positive.
Can you talk a bit about some of the design choices? Or some of the design choices for the ICO? I'm thinking about how much of the token is for the team, to the investors. Is it an uncapped ICO or a capped ICO? Is there a frozen, like a freeze on the funds that you keep as the team for a certain amount of time?
Freeze, you mean investing?
Freeze, I mean as the team can't sell any of the coins. You talk with exchanges. Can you talk a little bit about some of the choices you've made in the ICO?
Yeah, I can talk about some of them and some of them not. So let's say, first stay tuned. We will publish all this information, so it's going to be public knowledge. Some of the things which are obvious I can answer. Of course, there's going to be a vesting period, because any any project like that for the team has to have a vesting period where the tokens are received. The specifics of the token sale will be published quite soon. So once, I don't want to go ahead of ourselves. We are discussing a variety of collaboration at the moment with a variety of players, but I don't want to, again, sorry, to talk about them before they become public knowledge, at least not today. What was your, can you repeat the part?
Capped or uncapped?
Yeah, we'll definitely cap the ICO because we think that people should have an idea of how much money is raised. So we have some information on that. Last question?
Can you say something roughly about the ratio between what you will raise in a pre-sale and in public sale?
No. All right, so with that note, skål again for everybody, and thanks for coming on Friday. Cheers.